I struggle to see, Ben, to be kind, how you can game and start thinking about a bottom before you really get your hands around and have a deep understanding of the damage done to earnings, not just in the United States, but worldwide. And Ben, for me, it's too premature to do that. What about for you?
Yeah, and I absolutely agree with that. I don't think we're going to find a bottom here until there's some more visibility on those uncertainties about the contour of earnings in the latter half of the year. I think it's fairly clear that the initial hit to growth is immense. I think it's supportive insofar as you've had a few tests this week of market pricing in light of those, in light of new data coming out. So you had the PMIs earlier in the week, you had jobless claims today. Markets, I think, are willing to look through the fact that the initial set of data are going to be very ugly, but there's no floor here until we know what the contour looks like in the latter half of the year. And there are three major threats to the economy and markets on that sort of intermediate time horizon. One, obviously, the virus itself. You rightly pointed out earlier that it's a matter for healthcare professionals to forecast. Are we in this containment equilibrium or a non-containment equilibrium? Assuming we're in a containment equilibrium, I think you'd have some hope for optimism on earnings towards the end of the year. That's an open question. There's also the balance between the shock itself and policy. The fiscal package we saw come out yesterday and today is essentially a 2 or 3 month stopgap measure for income and as a bridge loan to firms. You may well need more from out of policy in order to counterbalance what might be an even deeper shock. So it's not, all in all, not difficult to find things that look cheap here. I think it's gratifying how markets have traded in light of very ugly data this week. But yeah, there's no floor until you see the bottom here.
That word to pick up on, Ben, cheap, and valuations. You'll hear a lot of people say things are cheap, valuations are good. Much of my audience have heard those things over the last couple of weeks. They heard it a month ago when the sell-off started. They heard it 3 weeks ago as the sell-off got deeper. They heard it 2 weeks ago last week. They heard it through this week as well. Valuations, by definition, is price relative to something. If you're trying to understand the valuation of something, I'm trying to understand, okay, here's the price. Relative to what, Ben, right now?
So I agree. Those intermediate term fair values have taken on a somewhat vague quality in this environment. But I think thinking about opportunities here and opportunistic investment is really a matter of principles rather than specific forecasts. So those principles are things like, first, identifying big dislocations. As you mentioned, that's not difficult because a lot of things look very dislocated. But I think you need a few other things. You need some persistence to the support of the fundamentals of those. So IG credit is a good example of that, where you have a policy backstop that we expect to be persistent and underwritten by a very determined Federal Reserve. And I think the third principle that you're looking for is that are these things structurally different after this is all after the virus shock is over with? So is it the case that people look at office buildings and density differently after this? Is it the case that people look at technology, which has been an incredible salve to a portion of the economy, different after this? And I think you're looking for places where you have a big dislocation, but also persistent kind of support from policy